front page centerpiece story this week of the Business Courier, clear signal with a big question mark. Despite claims from its CEO that it's not up for sale, some media watchers and investment analysts say the time is right for the E.W. Scripps company to shop itself. Scripps is one of Cincinnati's oldest companies, dating back from the 1870s. It's made the transition from an old-line newspaper chain to a TV and digital media company. Speculation about Scripps' future is coming at a time when the television industry is seeing a lot of buying and selling. As a result, investors are seeing a rapid increase in the share or the value of the shares. Scripps shares are up 32% since mid-June. Analysts say as much as 1/4 of Scripps' current stock price is related to the possibility it could be acquired, even though CEO Rich Bainey says the company is not for sale. Scripps' impact on the Cincinnati economy is large and growing. They've hired dozens of employees here this year alone. There are a few more dozen openings as it ramps up its locally based digital efforts. Scripps' 2012 revenue, $886 million. The company owns 19 TV stations, including WCPO-TV here in Cincinnati, along with some mid-sized newspapers. Any deal in which Scripps is on the selling end would more than likely hurt Cincinnati's economy and cost us plenty of high-paying jobs. So even though the CEO says it is not on the market, the primary duty of any public company is to increase shareholder value, and it looks like a sale would do just that. Business Courier reporter Steve Watkins wrote this story. Good to have you with us, Steve.
Thanks, Brian.
All right, so clear signal question mark. You say it's priced for sale, and yet Rich Bainey is flatly denying it's for sale. How do you get those two together?
Yeah, they sound contradictory, don't they? The analysts say the company should consider a sale, and they also point out that the stock, compared to other TV station owners' stocks, is one of the cheapest, and they think the reason is that Rich Bainey and the company's, the Scripps family that owns a lot of the shares, keep saying the company is not for sale, and the stock is priced lower, which makes it cheaper for somebody else to buy it.
It's important to point out that Scripps sort of split itself a few years back. It took its network affiliations, HGTV, the Food Network, off to, I think, Knoxville, Tennessee, and what's based here is now the television station, newspaper, as well as digital.
That's right, yeah. They took a lot of those higher margin businesses, as you mentioned, the cable TV networks, split those off there in Tennessee, and yes, everything else is here.
So what would shareholders stand to gain if they did so?
Well, a lot of the analysts talk about how the stock could get $21 a share in a purchase. Right now it's trading somewhere between 17 and 18, so that's a pretty nice increase. And the other thing they point out is right now, even though the company says it's not for sale, the analysts say about 25% of the stock price is what they call a buyout premium, meaning some investors think it could be acquired, and so they've bid up the stock higher than it would be if every investor just thought there's no chance of it selling.
So in watching that stock, that's kind of what tipped you off to this, it sounds like.
Exactly. That and the fact that all these other TV deals have been happening kind of in tandem. A few other acquisitions have happened in the TV market during the summer. That started not only Scripps' price, but other TV station owners' stock prices rising pretty sky high because investors think they could be the next one to be acquired.
Well, there was a time when owning 19 television stations would make you a big TV company, but not anymore. Those acquisitions really are creating mega companies, aren't they?
Yeah, that's the trend right now. The big thing is that TV station owners want to get big, and it all has to do with their negotiating leverage when they get deals with cable and satellite distributors. And so Scripps is mid-sized right now. They're the 14th biggest, although Rich Bainey, the CEO, says they're big enough that they could have done any of these deals that happened recently. They could have been the buyer as well.
And how do you think they can grow over the next several years?
Well, one of the things they are looking at is possibly acquiring another TV station. Also, they're putting a lot of money into their digital capabilities right now. They've spent about $25 million, or they will have this year. They've added more than 100 people, and they're doing a lot with their internet presence, both with their TV stations and with their newspapers in Cincinnati and then across the country at their other markets.
So this is a long-standing Cincinnati company. What are the possibilities that we won't see Scripps in Cincinnati any longer?
Well, it's a good question. It's really hard to say. And as we said, Rich Bainey, the CEO, he's also the chairman, and the Scripps family, we haven't touched on that. They own 90% of the stock. They all say they're going for the long term. They're not wanting to sell. And so there's probably a good chance they won't. Yeah. But the thing is, if they do get a really good offer, they are obligated to take a look at it and consider it. If it's good enough, they'd have to accept it.
A solid company, very consistent as well. So we'll see. Thanks, Steve. Great story.
Sure. Thanks, Brian.